Well, welcome to this second panel on the implications of digitalization on the insurability of risk and on the insurance industry. I would like to start, before we start the discussion with the panel, I would like to give a couple of introductory remarks on digitalization and the implications for insurability of risk. For the insurance industry, digitalization, I think, will have a material impact. Is very an important aspect because we are an industry whose main asset, whose main raw material to be operational is data. And now we are confronted with big data, much more data of different kind, and also with new tools and methodologies to work with that data, thinking about data analytics, machine learning, artificial intelligence. That opens up a lot of new possibilities for our industry, but as usual, possibilities also come with some challenges. On the possibilities, opportunities, the benefit side, I would like to bring up three benefits that we see coming from the big data, the data analytics, machine learning and artificial intelligence, the new technologies. First of all, big data and the new tools will allow us to reduce the asymmetry of information that we have seen over the last decades between the policyholder and the insurer. That will make insuring more efficient. An example, for instance, is with fraud detection. Given that we have more data due to big data, that we have better analytics, that we have artificial intelligence, it becomes easier for insurers to identify these policyholders who are frauding on them, especially in the field of claims, and as a consequence, we become more efficient and we can reduce the premium for the majority of other policyholders who are not frauding. A second advantage is that we, with all the data and with these tools, we get a better understanding of the risks, especially we get a better understanding of what are the drivers that can make the risks materialize. So predictability increases, and if we can increase predictability, we can increase insurability. So we can develop risk coverage and products for risks that we could not cover in the past, especially think about meteorological risks, where we are starting to work with predictive models and getting a better prediction of extreme events, or also in the area of health insurance, where we better understand the drivers for certain diseases to outbreak in certain persons. The third benefit, on top of the insurability of additional risks, is that collecting much more data and having much more data at your disposition on your policyholders, on your clients or on potential clients, we can better understand the person's situation and we can create risk coverage and products that are more adaptive to their personal situation, so we can individualize our offering better. And a good example here is the telematics that are used in the insurance of cars and drivers. Telematics that help us understand what behavior the policyholder has if he or she is behind the wheel, when he or she drives, where he or she drives, and we can price our coverage according to that specific risk profile that person has. So overall, a better understanding of the risk can also open a new business field for us. It can bring us into prevention, and it also can help us to support policyholders or interested individuals, risk interest individuals, to give them hints on how to behave so that they will be subject to less risk. So ultimately, this is a positive evolution because it allows the industry to really bring something else to society, prevention and support in risk mitigation, or support people to behave in a way that they are subject to less risk. So this is a positive extension for us as an industry, and it also creates more trust. However, as I said, the benefits also have the challenges, there are flip sides. And the flip sides, I would like to bring three elements up here. The first one is privacy. If we have all that data, and it is, of course, imperative that we consider very much how we use this data and how transparent, or that we are transparent towards the customer, the client, why we use the data, with which purpose, and what the consequence of that is. And secondly, individualization. Having this data on specific person, on specific risk, enables the creation, as I elaborated before on, of specific client-specific products, which in principle are good, but you have, of course, clients or customers who are subject to specific risk, for example, by a genetic predisposition that they cannot change because of their behavior. They just have that disposition, and these risks can lead to a high insurance premium for this individual. I mean, it will be up to us as insurers, and also up to society and to society and policymakers to think about how we want to deal with this. And my last point is a major challenge that has come into play now, and that is cyber risk. The digitalization brings a lot of opportunities and a lot of levers to improve our operating models, but also it brings with it a cyber risk. And this is also a risk that we are still looking and observing and looking for ways to deal with that. So far my outline, and I would like to refer on these topics, also refer to a study that the Geneva Association has published a couple of months ago, and it is on our website. And it's called Big Data and Insurance, Implications for Innovation, Competition, and Privacy. So I'd like to move on at this point to the panel, and I'm very happy that I have this distinguished group of experts with me here today. And I would like to introduce them to you. First of all, Homaira Akbari. Homaira is the president and CEO of AKnowledge Partners. Next to Homaira, Pierre de Villeneuve, the chairman of BNP Paribas Cardif. Then Shirine Khoury-Haq, the chief operating officer of Lloyd's. And Vicky Saporta, the chair of the executive committee of the IAIS. Homaira, if I may start with you, I would like to get your view, a big picture view, on how the digitalization has changed the insurance industry in the United States, and where do you see comparison, or what developments do you expect from there for the European insurance industry, and where do you think we can learn something as an insurance industry? Are there other industries that we can look into to learn from?
Sure. First of all, hello everyone. I just for your information, I'm a technologist, so I have never been part of financial industry except the fact that I'm on board of Banco Santander. And I live in the US. I live in New York City and Dallas, and that's relevant because I'll bring it up later. Regarding insurance industry, a lot of, and when I talk, I will talk from point of view of technologists, so it may be there are provocative things that I would say, but that's the purpose I'm here for. And from point of view of technologists, insurance industry hasn't changed. 120 years of no change, and continues to be no change. And if you think about it, I was running a business in France called Thales Telematics, which were about 100 million euros of revenues, and we were operating in different countries, including South Africa and UK. And at that time, we already partnered. This is 2003. We already partnered with IBM to create a crash box for an insurance company out of UK. We did some trials, it never really got deployed, and that's the story that a lot of technologists believe, that insurance companies talk about technology, they play with it, but they never really deploy it and they never really leverage it. And we'll come to that and how that will change. However, having said that, I do think, the more I think about it and the more I, preparing for this speech, I have come to believe that, you're facing a tsunami, and it will happen, and then it will happen on many, many, many different layers and many different ways than that you expected it before. before, when that tsunami will hit you, I don't quite yet know. It may be 3 years from now, 2 years from now, 5 years from now. But it's not going to be 20 years from now. So it's a matter of years now. And the reason I know that is if you look at, and I do think this is a very good index and benchmark that you can always use, an indicator, if you look at how much venture capitalists are pouring money into so-called insurtech, effectively in 2015 it tripled or quadrupled to almost 2.6 billion. 2016 was 1.7, and then year to date now it's almost 2.6 billion again, so it's gone up. A couple of interesting notes, even to the year to date, the money went to about 200 different players. 1 billion of the 2.6 was in 10 players. And, companies like Lemonade that we will, I'll talk about later, or Root, which just raised in Series E $100 million and valued at $1 billion, and the company only exists since 2015. So I do think, just summarizing it, I do think that insurance has been so-called in Web 1.0.0, and it sort of started 1.0 a couple of years ago, but it will soon, the 1.0 will really start giving results and we get into Web 2.0. Of course, the characteristics are not the same as what Web 1.0, 2.0 was. If I have to summarize, digitization, how digitization today is impacting insurance sector, I will divide it into 3 pieces. So the first one is pretty classic, although I do think insurance sector is behind financial services certainly, or banks, I should say. And the first one is basically using technology to your advantage to create efficiencies, higher productivity, lower costs in your back office or front office. So anything from claims, underwriting to claims management and policy management. So I think you do see some startups or some insurtechs that are taking advantage of that and providing those solutions, but really providing it to their customers being insurances, which is disruptive, but not, and you have to use it, and we were going to have an IT person here as a speaker who could have spoken about it endlessly, but it is not something different than anybody else's, any other sector using AI, machine learning, distributed ledger blockchain, and cloud computing. Secondly, the way digitization is impacting insurance industry is really the engagement with your customer. So classically, this is a weakness that insurance industry has because you don't really know your customers because you go through so many brokers. Now, in the US, auto insurance now is a lot more directly towards the customers, but generally speaking, insurance has work through brokers. And I'm amazed when I think travel industry was disintermediated, late 90s, and here we are, 2018, and insurance industry is not disintermediated in terms of its brokerage, and they're making somewhere between 27 to 35% of your taking away from your top line, when your margins are going to be under serious attack, which is already under serious attack. So we'll come back to that, and I think there you're seeing huge disruptions. Companies which are really coming in, startups who are saying, you know what, I'm looking at, and the average age of consumers there is only 34. He's saying, here I'm going to go to millennial, I'm going to offer them insurance, and I'm going to do it through mobile. And when you think about those startups and why they're successful, they say mobile first, aggressive pricing, partnership, and favorable regulatory requirements or environments. So which is against financial sector, including insurance. And the third area digitization is impacting you, which is the most disruptive way, is really completely changing your business model. Not necessarily, completely changing in a sense that for always, sometimes it's just the same things you're offering, but in a different way. And that's where we come, where IoT, social media, digital records are going to completely change. They're already trying to change, but it's been a lot of push. They're going to change how the insurance industry will will work and will function. Really there, as example, if we take automotive, so how it really impacted these three areas that three areas that I talked about. So there are several ways that automotive startups effectively, or technology companies, have tried to impact automotive insurance. First is, which was the very original way, was like what I was trying to do back in 2003, to really have telematics devices, which you mentioned earlier, to help understand driver behavior, to do pay as you go or usage based. And insurance, Progressive in the US, for example, was one of the first ones to adopt it. Here, in fact, the largest telematics, auto telematics company in the world is in Italy, called Octo Telematics. And you saw very good growth in 2010 to 13, and I am in that industry, so I was buying companies and selling companies and working with private equity. And I am sad to say that there are some of those companies just withered away, because basically insurance industry after like 2014 said, you know what? I'm not sure what I want these telematics boxes. They're too expensive. They're actually changing my risk pooling model. I don't like that. They're actually making me less money. I don't want to give, I don't want to, low risk individuals can't get cheaper premiums because I need their premiums. And that's really, the fact of not wanting to sort of cannibalize yourself. But so that sector has stagnated, but partly because of the insurance sector or companies not wanting it, but partly also because of technology confusion, because of mobile phones. In fact, you can do a lot of things that these black boxes do now on the mobile phones, almost all of it, which is at zero cost, which will come back to zero cost. So in automotive, so you have a series of technology companies who've tried to provide technology to insurance sector, and they've felt a lot of pain, and they're struggling because, in fact, insurance companies are not trying to adopt the technology as much as they could have. So then you got a bunch of, other startups who got frustrated and said, you know what, I'll go do that myself. And the examples of those are a company called Metromile out of California, which basically offers usage-based, and they've done good growth. They did run into loss ratio because, they'll learn. And so they slowed down, but they haven't died, and I think they will continue. And it's like, Web 1.02, they're going to pivot, and I think they will be successful. More interesting model is a company called Root, R-O-O-T, out of Ohio, which is from all the places in Ohio, not Silicon Valley. And they're $1 billion. They exist since 2015, and they're using the driver behavior and driver scoring to completely change the way they do the premium, and they really believe that they have decreased the risk algorithm using AI to be able to know what is the risk, and therefore to decrease the cost. So taking automotive, and by the way, what they do is completely mobile first. So all of the policy goes through the mobile first. So taking that example of automotive, and I can give you examples of many other parts of the sector, I think it's a very interesting way of starting this discussion.
Thank you, Mara. Some very interesting examples there. I'm impressed by the amount of money that goes into the insurtechs, but I also know that some insurers are also investing in the insurtechs, and from that, starting perhaps Pierre, l'assurance, comme on a été une industrie qui a toujours été.
The insurance sector has always been data-based. Where can you identify those major opportunities in the digitalization processes to extend our role in society, and the offer we can provide, and how can clients really take advantage of this? Well, there's no doubt about it. We have and will have. We have had and will all have a whole gamut of opportunities with a very strong social accountability. First of all, as a risk taker, as risk takers, we're going to be providing more services and more prevention. And furthermore, the range of protection, insurance protection, is going to be increasing through already known risks, but that can not always easily insurable today, and new risks. So I'm not going to mention the services or prevention so much. Those are two important fields, in which insurance companies are really displaying a lot of engagement. Insofar as protection, the data wealth and the increased number of algorithms are such that we're going to be able to provide more customized products and the same level of guarantees and services with costs are going to go down. And this decline is going to be related to lower claims because of artificial intelligence. Quite a number of procedures and services are going to be automated, hence lower costs. And insurance holders will have a direct access to the answers which they need. And perhaps most importantly, and you've already mentioned this, we actually are going to get into a new insurance approach. Our prices are not just going to be based on the observations from the past, but working on predictive hypotheses. In other words, we are going to be able to come up with a dynamic guarantee proposal with frequent adjustments so as to acclimate ourselves to various financial situations and evolving needs among insurance holders. And actuaries are going to be working in a more accurate fashion thanks to data science and thanks to connected objects and by integrating behavioral data. Now, we're going to make headway, and this headway is going to be impacting all of the sectors inherent to the insurance industry. Now, how fast? Well, this velocity is going to be depending on how all the stakeholders are going to be able to adjust themselves to that new ecosystems. And now we've got distributors, retailers, and, of course, service providers, and regulatory authorities and prudential authorities. And this was tackled, actually, in the previous panel. Now, in just a few minutes, I mentioned more services, more prevention, a better customization possibility, lower costs, lower prices, and adjusted guarantees. And those are quite a number of fields for improvement. I would like to supplement with other 3 areas for improvement. First of all, insurability is straying away. Now, it is a quite important topic today. Now, our people's ability to have access to insurance products with lower financial possibilities and another area for improvement, new risks. And so far as the first item is concerned, we talked about this already, but that's where we should be really making a lot of headway with all of the data. But this all depends on how insurance holders have access to the data, or the carriers. Now, with the connected objects, well, those connected objects are going to be providing a whole gamut of information in all of the various sectors. You mentioned the automotive sector, or motor insurance, because that's where we're going to be benefiting from those. So, all the sectors are touched, but I mean, really indirectly mentioned the agricultural risk. With connected objects, we'll have a lot more information. Now, there are hurdles to all this. Now, the hurdles are either related to the exchanges and there's the discussions and negotiations and conflicts of interest within the industry, and other hurdles which are regulatory hurdles. Now, today, we already have a great number of data in the metal sector, which insurance companies have no access to in an anonymous way. They cannot just harness those data from a commercial standpoint, and that's too bad, because there are insurable risks provided insurance companies have access to those data. Another point, another item regarding insurance accessibility, microinsurance for limited people with limited financial resources. What the Cardif affiliate in India is doing is quite extraordinary. We're proposing insurance offices with fees, for less than €1 a month. And this is addressed to those people that really need to be covered with a very simple product. The easy to understand, easy to subscribe to, is just to have an easy access to coverage in the case of claims. In Europe, we should be able to further develop insurance offers among a greater number of people, including people with limited financial resources. As far as the third item is concerned, which I wanted to tackle, of course, new risks. Now, we have been talking about those new risks quite extensively this morning. For example, cyber attacks and anything that revolves around algorithms, attacks, failures, and the misuse of algorithms. And the last two items are quite important. We're talking about attacks, but I mean the way you use those algorithms. And this is a problem. This is an issue. This new world, this new cybersecurity world requires or is a major source of concern, and there's a major need attached to this. So this is quite a comprehensive and complex issue. A complex issue, why? Because of the very nature of the potential sources of claims. This was mentioned, a cyber crime, a cyber spying, and anything that has to do with malware and sabotage, another complexity. We're talking about problems that go well beyond national interests. This is a transnational issue. This is complex. Why? Because there's such a gamut of IT sites and applications. We also got partners and suppliers, and this makes the whole situation even more complex. How can we define guarantees? I mean, this also makes it very complex. Guarantees, okay, liability, claims and liability, casualty and liability, and losses incurred. But many other guarantees could be proposed, and complexity is also related to the needed services. Those services of prevention services, and services should be provided in case of crises because policyholders should be helped in responding to the crisis because there's a genuine risk to this. In terms of digitalization, we got a whole range of opportunities ahead of us, but I'd like to hammer this home. This really, we got a long road to hoe with a lot of innovation. Given the stakes and needs for both individuals and companies, it is quite crucial and instrumental to all agree on the fact that this transformation and innovation work to really be top of the list priority for the social interest among individuals and companies. And we could actually prioritize things, and some initiatives are important with less of a social added value. Thank you, Pierre.
A lot of possibilities, a lot of opportunities, also a lot of work that needs to be done with urgency behind it. But I also hear some new risks, like cyber risks that may come up. And I would like to use that to move on to Shirine and ask her, where do you see the consequences of these new digital technologies coming to play into and around our sector, especially cyber risk and eventually some others? And we as insurers, we can also play a role in mitigating cyber risk. What can we do to promote a safer cyber environment, and also how far are we, or what can we do to mitigate that cyber risk?
And thank you for the question, and I'll really build on what Pierre had to say. But I enjoyed what Homaira had to say as well, and I think that if you maybe took a look at what we're doing in the commercial sector at Lloyd's in the London insurance market, you might be surprised at how much we're doing with technology. So maybe we'll get to that a little bit later. But back to my topic of cyber. So we know, and we've talked about how almost every business, and you could argue businesses outside of the insurance industry even more so, are relying on digital technology. And while it helps companies become more efficient, reduces their costs and opens up new markets, it also makes them much more vulnerable to cyber attacks. And forgive me, I'm looking at my notes because I want to give you some numbers around this as well. So businesses today are very different from what they were 40 or so years ago. If you look at 1975, the split of assets for the S&P 500 market value was 83% tangible and 17% intangible. If you look at it today, it is the complete opposite. It's 16% tangible and 84% intangible. So data, not physical stock or infrastructure, is now the asset for our largest organizations. And this also goes outside of the United States as well. So if you think about Skype, Skype is the biggest telecommunications company in the world, and it owns no network at all, no telecommunications network. Netflix is now the world's largest movie house, and it owns no cinemas. So the assets of these companies are digital, they're data rich, and their value is based on their IT systems, their intellectual property, their data, and very importantly, their reputation and their brand. So cyber, right now, we think is one of the most complex, current, critical risks that businesses face today. And it's really not a matter of if the company will be attacked, it's a matter of when there will be a cyber breach or attack. And I think all of us that work in the operations and IT space, we understand that, and we really take it seriously. Our studies show that in 2016, cyber attacks were estimated to cost businesses as much as $450 billion a year. Now, unless it's legislated that they report those breaches, you don't know the actual number. So these are our estimates. Companies can lose business, they can face litigation, they can see their share prices crash, and they can have their reputations and brands destroyed if they have a data breach or a cyber attack. And we know, we all hear about these almost daily now, these big cyber incidents that involve leaking of customer information that brings this really to the front and center. So we've heard what happened to Equifax, to Yahoo, to Google, to Facebook. These are global names. These are technology companies, and they are also being attacked. So think about what happens to our clients that are not technology companies. So in the immediate aftermath, for example, of the data breach at Facebook, their share price tumbled. They lost $13 billion overnight. That is a huge, huge impact. And it can be catastrophic for a business. The Panamanian law firm that was in the middle of the Panama Papers hacking scandal, this was a company that leaked, unfortunately for them, millions of customer records that resulted in the tax evasion scandal. It couldn't survive. It was a 40-year-old firm. It was the 4th largest provider of offshore services in the world. It is now shutting down. It's finished. So Lloyd's has recently published the City Risk Index, which looked at 22 man-made natural risks and their economic effect on 279 cities around the world. And it showed that cyber attack is number 7 in the risks of the risk globally, which risks almost 37 billion of GDP around the world. In Paris, we think it's the 3rd largest risk after a market crash and flood, with an annual risk potential of more than $1 billion. Regulations are getting tighter. So here in Europe, we talked about it earlier, we've seen the introduction of the GDPR regulation, and that sets rigorous standards for any business dealing with European customers' data, and it imposes severe financial penalties. And we think that the cyber market has exploded. We published again at Lloyd's the Business Blackout Report last year, which looked at the business and insurance impacts of a cyber attack, for example, on the power grid of Northeast America. And we estimated that the cost to the US economy could be between $240 and $1 trillion if you think about the contagion effect of a serious central breach like that. We think that a major global cyber attack could trigger about 53 billion of economic losses, and in insurance terms, that is the equivalent of a catastrophic hurricane like Superstorm Sandy. So these are on equivalent levels. And while the risks of losses are huge, the need for cyber insurance, we feel, is increasing. The majority of those losses currently are uninsured, and that leaves an insurance gap of tens of billions of dollars. And it's a real opportunity for the insurance market. Our Lloyd's class of business team estimated that the cyber market could be worth between $3 billion and $3.5 billion by 2020, but some analysts think that it could be even higher than that. We're at the forefront. Lloyd's currently has a 33% global share of gross written premium in this class of business. The majority of that, 80%, comes from the United States. 6% is from the United Kingdom, 1% from Western Europe, and the remaining business is from the rest of the world. The reason why we have such a large share of our business in the United States is because 46 out of the 50 United States have mandatory requirements for data breach notification. And compulsory regulations for reporting data breaches are the driver for insuring. In comparison, we have much lower insurance here in Europe. I was delighted to hear this morning from Sir Julian King about the initiatives that the European Commission is now putting in place, and I'm hoping that that means an increase in the penetration of cyber insurance in this market. GDPR, in addition, hopefully will help that as well. Just a few minutes on Lloyd's. Lloyd's has, as I mentioned, a major global share of this market. We currently have 75 cyber insurers that are experts in this area, and that's how we deliver on this risk. But I should talk about that opportunity for the insurance market, but there is a flip side to that as well. Technologies are moving, as we talked, on a daily basis. They're moving so fast, and so do the skills of the cyber criminals that are determined to expose vulnerabilities that technology brings. So for underwriters, we need to ensure that we collect all the information that we can to insure against a risk. So volume of sensitive data, value of data, that is very hard to quantify, and the loss of that, depending on how and where it goes, is very hard to quantify. We need to understand the security protocols that a company follows, the motivations for an attack, the geographies, the vulnerability of the supply chain. If you think about the contagion effect, if you are linked technologically to one of your business partners, they're hacked, and the hacker uses their link to you to hack you, how do you quantify that risk? How do you protect your customer? Whose fault is it? And how do you pay them out? These are very, very complex areas that insurers really need to think about. So to wrap up, it's a real and present threat. The European market needs to catch up on this. It hasn't yet. And we also need to help our customers. Our customers, our potential customers, are currently either not fully understanding the risk to them, or they're not looking for solutions because they don't understand the risks. And we have a responsibility to help them understand it and also to help them mitigate it. And when things go wrong, to help pick them up. And resuscitate their business.
Thank you, Shirine. Thank you for this very informative overview, and especially also for the data. Because by having the numbers and having the data, you realize how big this risk is, and how much currently, how few are currently insured, and what can happen, what the consequences can be. Now, Vicky, having heard about the coming tsunami in a matter of years, having heard about all the activities that insurers can do and will intend and will do in order to integrate digitalization into their business model and in order to serve better their clients and society, and hearing about that enormous cyber risk that is out there, what's the mood with the policymakers and the regulators? How are you approaching this digitalization within the insurance industry? Do you see any limits for digitalization in the insurance industry? Also, in the previous panel, there was a discussion about digitalization through platform players, taking another approach at competition, going across industries and blurring the line of insurance industry. What are the considerations that regulators are having for the moment?
Yes, I should say that I think all regulators around the IAIS table recognize that this is a trend that we need to take on very, very seriously. And indeed, within the IAIS, over the last 2.5 years, we are spending unlimited resources because we have lots of other things to still finish to understand much better what the trends are and to help supervisors deal with them and to understand essentially what the supervisory practice is. And we are now in the process of actually defining a new strategy, a post-2019 strategy after the completion of the more traditional reforms having to do with capital and financial resilience. And we intend in our new strategic plan to actually spend even more of our time on this. So the issues are recognized, and the fact that supervisors need to respond are recognized. The current international landscape, however, in terms of our responses, is variable. First of all, quite interestingly, most of us, I think, work in advanced economies and have worked in advanced economies for most of our careers. But actually, in the insurance business, it was the emerging markets that first actually innovated in this area. China, South Africa, so the advanced economies within the insurance business are actually catching up. And I would say that something similar is happening with supervisors. So initially, amongst the table, it was our emerging market supervisors that were thinking about how to exploit InsurTech for more inclusive insurance and to actually get more access to the consumers. So that was an interesting lesson. So in terms of the variety of approaches, I think what I have observed is related very much to a previous point that was made in a discussion in the first panel about mandates. So where the mandate of the insurance supervisor includes innovation and competition, you see insurance supervisors having developed sandboxes and innovation hubs. The Financial Conduct Authority, which is my twin regulator in my day job, because I'm a prudential regulator with the Bank of England in my day job, and the Financial Conduct Authority is the markets regulator, where I think amongst the first in Europe to actually develop the sandbox and innovation hub. Elsewhere, you have seen it in areas in Asia, where Singapore has been, the regulator in Singapore has been very, very active. And they tend to have competition and innovation, but also they need to take into account competitiveness concerns. Now, there, if I take a tangent away from digitalization and try to intervene in the discussion that we had earlier, my view is very similar to Gabriel's, actually, that, of course, economic growth and market growth are incredibly important objectives, national and international, in capitalist societies. They tend to be, of course, the public policy objectives of governments and ministers of finance. And trust me, they do spend a lot of their time trying to promote economic growth. They do tend, in most advanced economies, to delegate prudential regulation and financial stability to independent regulators and central banks, including monetary policy, actually. And why is that? It's precisely because they do not want to enter a political cycle where all the demands are for growth and jobs, and therefore they create these regulators to push against that. And what is the rationale? The rationale is that if safety and soundness and financial stability actually does not get maintained, then you have backlashes. And let us not forget the 10 years of a crisis, which actually do affect the public purse. So although innovation and competition are very, very good things, and conduct regulators are very well placed to promote them, and they can increase productivity, and the actual, what economists call the real competitiveness of one economy relative to the other, competitiveness through beggar thy neighbor, loosening regulatory standards, first of all, is not real competitiveness, and second, completely, in my view, negates the objectives of independent regulators. So I think amongst the regulatory community, there are a number of regulators, mainly prudential regulators, that feel very strongly about these issues, but are, on the other hand, will be very, very careful to be at a minimum technology neutral, and at a maximum, which is something that I support, particularly if it's in the mandate of a regulator, conduct regulator, to promote safe innovation through sandboxes and innovation. But it needs to be safe, because ultimately it's the public purse that could be again at risk through bailouts. So, so that's kind of what we see there. In terms of the challenges we see in terms of insurance regulators, first of all, I would like to be honest. I mean, regulators always tend to follow developments. We can innovate as regulators, as the FCA did by setting up the first sandbox, but we cannot regulate in your markets, in a market economy. So necessarily, we need to follow. So, so what we're going to be observing is probably with a lag, and that's why it is so important to talk not only to the insured firms, but to the technology firms as well. And this dialogue with the technology firms, regulators engaging with technology firms, is becoming ever more important. And I'm also a banking regulator. This is also the case, very importantly for banks, which I agree with Homaira, have been in this game for longer. So that's one. We need to understand who are the other providers who might be non-regulated at the moment. Mm-hmm. And this is not something that we do normally. And also, will the technology companies speak to us? I mean, we are used as regulators that, you know, whenever I want to speak, I can go and speak to the CEO of the bank I supervise for obvious reasons. This is not the case if I want to go and see Jeff Bezos. So that there are issues on that front as well. Secondly, we've already been touched on, is the development of personalized pricing and segmentation, and this is touched by everyone. This is challenging the so-called pooling model, but so what? On the one hand, if it's going to offer services to people that didn't have them, old people that couldn't get access to car insurance, which are now getting access to car insurance, and it's an area that I'm personally interested in as well, or I will be sooner or later. It's you know, it's great from a social perspective. But what about the low risk people? The high risk people who are going to be excluded? And what are the public policy implications of trying to get them included? Now, some of these issues are not new and have nothing to do with digitalization. We have them in the UK, for example, where house owners in areas that are very vulnerable to flooding couldn't get insurance. We had them in the UK after the terror attacks. So governments had to go around with a flood example in the UK and get insurers to set up a reinsurance company and get them to commit to insure these homeowners and then reinsure with a flood company. But that required public policy and government intervention. And I'm wondering what sort of other interventions these will be, these other issues as we're getting this segmentation may require, and what the fiscal implications of those might be. Then the other issue that again has been touched upon is, of course, the value chain is being segmented. I mean, mostly, we see it mostly in marketing and distribution and claims management, less so in underwriting. But underwriting will happen or is happening already in some cases. The question is, what does that mean about the regulatory perimeter? And some people have been talking about activities-based regulation rather than entity-based regulation. But this is very, very difficult because ultimately you're supervising legal entities and not a combination of entities. But this is a very big issue. And I think it's an issue that we as regulators need to think about and will have to think about very seriously. Now, another area where the issue is likely also could become systemic is, of course, the increasing reliance of data dumps into the cloud and the concentration, of course, that Amazon, Google, and Apple have on that data. So are these three companies now systemic? And how do we regulate them? Do they become utilities? And the utilities definitely get regulated. What do we do with that? I mean, in most Western European and advanced economies, the approach has been to still focus on the insurer or the bank or the regulated entity and get them to be responsible for the relationship with the outsourced entity, exactly the same as with outsourcing. But the question is, who has the leverage in this game of oligopoly? So that's another big issue. Data privacy and data sharing concerns, we have already mentioned. And of course, artificial intelligence and algorithms that lack transparency. And ultimately, this issue about algorithms that work and can achieve predictability through correlations rather than causations. What does that mean about the transparency to the individual? So let's say I'm very, very poor, but I'm a very, very good driver. But because my credit score actually correlates so well in big samples with driving ability, I get a very high insurance premium. I cannot reduce my risk. What do I do about that? Maybe telematics can help on this particular issue. But this provides lots of kind of social issues as well, if there isn't sufficient transparency for me to understand why I get a particular premium and how I can get this premium reduced. It's a huge conduct issue. So there are many other issues, and you can see how much work we as supervisors have to do to answer all of these questions and the different practices that we have to do. But let me stop here because I can go on all day. On cyber, Well, I mean, as it was said, amongst many financial services firms, it's the number one risk. It's quite interesting from a regulator point of view, because normally we are used as regulators to deal with kind of financial resilience. Of course, we are interested in operational risk, but most of our work in the past has been capital, liquidity, solvency, etc. So there, it's quite clear that our incentives are misaligned with the market. We would want insurers to have more capital than they would normally want, particularly for firms. But what about operational resilience and cyber resilience? Is our tolerance misaligned? Perhaps when it comes to issues around the cloud, but it's not very clear how misaligned our incentives are, because I think that a lot of companies have a lot of private incentives to actually protect themselves against cyber. We are obviously developing our approach in terms of insurance companies, I'm saying. In terms of the payment system, then the incentives are completely misaligned. And over there, cyber stress testing is becoming increasingly the area to go for, in my view. On cyber, protecting companies against cyber attacks is, from a regulatory perspective, a common theme among sectors. Amongst banking, insurance, asset management, etc. But what is unique to insurance and to insurance regulator is cyber underwriting. And we just heard about Lloyd's success there, but also the immense opportunities that exist, including in Europe, where we will have to do something as regulators. The question is, do they have the right data to actually do it? As far as I know, most of the pricing is done using quantitative techniques, and therefore, how robust is the pricing, and will the pricing actually be? And what does that mean about data sharing in an area that is very, very sensitive, also from a state security point of view? So let me stop here. Thank you.
Thank you, Vicky. That's a lot of challenges and a lot of work. And the one notion that came back a couple of times, and it's also, I think, a very important issue, is the demutualization and the fact that through the individualization of premiums, some people will not be able to afford the premiums, even though perhaps the premium does not really reflect the risk they have. So, je voudrais reprendre ce point et revenir vers vous.
I'd like to come back to you, Mr. de Villeneuve. How do you see this demutualization matter, the fact that there will be people who will have to pay very high premiums, not necessarily related, I mean, this shouldn't necessarily reflect the conditions of the company, but it should be based on correlations. How should insurers address this topic, especially society at large? How do you think that society at large could react or should react? Thank you for this question. And you addressed it, madam. It's a real ethical and social matter. It's very fair to make personalized offers, taking into account the differences in risks amid policyholders managed within the same pool. If, in addition, the risks that we insure rely partly on the behavior of policyholders, then such an approach seems to be quite virtuous, since it spurs prevention. Having said that, and you are underlining it, an in-depth personalization pushed to the extreme may lead to discrepancies. So we should look at what are the limits of the data use, and in terms of the pricing. And the data is very clear. In Europe, in the general data protection, it exists, and we must apply them, and we must avoid to use for individual pricing data related to the privacy, intimacy of policyholders. By the way, such requirement, which is normal, should not block the transfer of information in an anonymized way to the insurers to allow them to track the developments in the markets. And additionally, it would be normal as well to accept exceptions for high capitals. Switzerland is an example of that. Now, with regard to the pricing matter, certainly we need to make prices that do not result in discrimination. This is what you mentioned, Madam Chair, for people who would not have any cover for reasons independent of their desire. Given the precautionary matters I've taken on data, we should be able, I believe, most of the time to insure a large number of people and make sure we don't resort to discrimination. Having said that, for specific situations, for a number of covers where too high a segmentation could lead to special cases, well, then there are some solidarity or support techniques that we could put in place in various forms. I have answered your question, but I would like now to address another point regarding asymmetric information, because you underscored this, Madam Chair. Well, common sense is that with more data, one might believe that there would be less fraud. But let's keep an open eye here. Well, policyholders, in all likelihood, for data protection reasons, they will have data that insurers will not have, and with more customization offers, policyholders might be tempted to play with their data in order to be able to benefit from the offers for the best risk. So, on the contrary, we'll have to be increasingly vigilant, therefore. We've insisted on the increased personalization of our offers. I take this opportunity to say that in parallel to this development, we should see a development of parametric products whose services would be totally independent from the policyholders. But these services depend on external factors to policyholders, such as how many sunny days, delays of trains, and this is a development which follows the wealth of data that we'll have compared to the past and the reliability of such data. So customization is certainly something very good. So great that we see it expanding, but I do hope that collectively we'll make sure that we can continue to be able to promote one of the main goals for all of us, namely accessibility to insurance to the largest number. Thank you, sir.
Shirine, I mean, you made me curious when you were explaining about the digitalization and what it does in Lloyd's. You mentioned some examples of what you do in the commercial lines. Could you elaborate a bit on them? And also from the angle, do you consider this an incremental evolution on your business model? Do you rather see it as a real disruption? I would then also like to pass that on to Homaira, because Homaira talks about a tsunami. How you see it with current evolution?
We're going off topic now, if you're okay with that.
Yeah.
So basically, you'll know that the insurance market in London and Lloyd's is 330 years old. And that way of doing business hasn't really changed much over that time. However, what we've been doing is we have a modernization program across our market, which is the one that I'm leading. We have 350 firms that are working together to digitize the insurance process. Now, you can say that it's an extension of what we're doing now. There's a good reason for that, because there were decades of failure along the way. So we had to get 350 firms to believe that things could happen. Mm-hmm. So we're using new technologies that can then work with blockchain, that can work with IoT, that can work with AI to take the market on the first step. So we have, we've been improving the way that we move money. We've been digitizing the underwriting process. We have been developing data standards that are global data standards, not just within our market. And we've been improving the way that we deal with partners around the world. So we have 4,500 other insurers that write business on our behalf. So all of that has been what we've been doing. And when you work with your competitors this closely, you have to kind of limit, you have to very clearly draw the line. What is competitive advantage and what is not? So we have been building a technology and data infrastructure that everybody can build on. And we have been working together as a market to build common processes, and we've been working with our software partners to be able to engage with us and take us to the next level. But then each individual insurer, broker, partner is doing their own bit. So Lloyd's, for example, we have been working on changing our processes using machine learning and artificial intelligence from the regulatory advice that we give, and then taking it more into data and decision making. We have recently opened a lab, and all the way across, for the last 3 years or so, we've been working actively with hundreds of insurtechs. Most recently, we have scanned the global market. We have selected 200 insurtechs. We've narrowed that down to 10. And across our market, we've defined some themes, including a wild card theme, which is the tell us what we didn't know we actually wanted. And we have 10 insurtechs that are partnering with 40 of the insurance companies within our market to build active prototypes in the next 10 weeks. And these are sharing data, sharing business processes, introductions across our global network. And so this is, we really couldn't do that when we were sitting on 300 years of paper. Now that we have data, now that we have the digital infrastructure there, that is a very, very rapid pace of change, whereas getting the whole market there was much slower.
So it's major refurbishment in a very short amount of time, actually.
Yes.
Yeah.
That's very good to know. And obviously, I didn't mean every insurance company is not. But you know, as Victoria said, generally insurance companies are behind behind banks in sort of looking at new models. But one of the things I wanted to say is. There are a couple of things which are happening, which is very interesting, and would like to get your feedback on that, or how you're dealing with that. One is when you look at different sectors, and consumers are changing. I mean, things are changing out there, and therefore you have to have new models for insurance. For example, the whole ride sharing, the whole bicycle sharing, the whole Airbnb. So how do you insure for these, shared economy and the way the new things which are happening? And that's where startups, True falls in, and they do on-demand insurance, and they do it fast, and they do the claims fast, or Lemonade for that matter. But the second one is, for example, back to automotive, what's happening there. So I live in Dallas, and I don't have a car. And Americans, when I tell them that, they go, you got to be crazy. And I am crazy. But I do believe that you're going to see car ownership going down dramatically. And I'm not a millennial, but I happen to be early adopter of it. I mean, I rent a car when I need, and I Uber everywhere. I'm one of the biggest Uber users. And so I think that when you look at that, and you look at autonomous vehicles coming in, how do you insure all of these things? And there are startups which jump at that, and they quickly address those matters, versus insurance companies which think about it, talk about it, hypothesize it, but they don't try it. And so I think that's those are some of the opportunities that insurance companies are leaving on the table. And I think issue, just as is for the banks that I'm involved with, is cannibalization. I mean, you're making a lot of margin currently on the way you're doing things. The question is, how do you want to shift? And at the end of the day, Netflix was mentioned. And Netflix, the reason they exist and they have such a fantastic valuation is because they cannibalize. There was a point where they went through a downturn because they said, you know what, we're going to cannibalize. It's this is, even though I'm making a lot of margin, it's going to be streaming media. So how do you, I mean, I don't know if you have response to these new models and new really things which are happening and you need to react towards them, I think, a lot faster as an industry.
I guess I don't, we shouldn't make this all about Lloyd's.
Yes,
you know,
of course.
the why, but we have a couple of syndicates that specialize in autonomous vehicles.
Yeah.
And we are on the emerging, I mean, we were the first ones to insure airplanes. We were the first. Generally, when something is strange and risky, it ends up in Lloyd's somehow. so you know, so we are already there and but it's difficult because, you know, when you think about autonomous vehicles, if something goes wrong, who's at fault? We had an issue recently, didn't we? You know, is it the software? Is it the car malfunctioning? Is it the guy who was reading his book instead of pushing the brake when that woman was run over on her bicycle? The autonomous vehicle couldn't tell if it was a person or a bicycle, and then ran into her. So there are these difficulties. But I agree with you, and we talked about it on the cyber front. Insurers need to not only look at technologies in terms of what they do and how they do it better. And you know, you've mentioned a lot about the consumer space. There's a huge amount of opportunity there. We're all insurance consumers. Are we all interacting with our insurance companies in the best, most digitized way possible? The answer is no. There's an opportunity for us in terms of in the commercial space how we work better as well. But then these emerging technologies, you know, Lloyd's is lucky to have the brand that it does, but there is a wider opportunity, like I talked about on cybersecurity. There needs to be more penetration of insurance in these markets that don't quite know what the risk is to them and what the damage could be.
Yeah. Okay. Thank you very much. We do not have so much time left, so I would like to open it to the audience. Are there any questions from the audience for the panelists? Yes, please. Could you please introduce yourself as well?
Yes, I am Magzaka from Lebanon. Certainly, insurance through IT is on the move, but I'm going back to cybersecurity. If you listen to the American companies who are insuring cybersecurity, first of all, it's not so easy to insure. Secondly, when you come back to to claims, they say, well, of course, you don't know how we are going to settle claims. It has to go to court, and then we will see. We have no legal cases. So I wonder how cybersecurity insurance will go on from there. Thank you.
Shirine, would you want to spend a couple of words and then eventually Vicky as well?
So you're talking about the legal framework and how a consumer is protected.
How it is today and what the challenges are, and perhaps Vicky, if you have a view on
you know,
where
this
it should go.
This isn't my specialism, but I know, again, from our perspective, we have to be quite careful about the countries in which we write business, because the legal framework must protect the customer, and we have the regulators to also help that in some of the more developed areas. But insurers, in order to protect those customers, need to be assured that they themselves are protected. In some jurisdictions where the legal infrastructure isn't as mature, as an insurer, you really don't want to go there, because often you know, the claim isn't evaluated properly. You may end up having to pay for something that you necessarily shouldn't. So you know, I think for me it really depends on the location and the place where you're doing the business, and the regulators and the legal infrastructure involved. So there may be someone who can answer that one more authoritatively.
Would you want to add something, Vicky, to that?
I guess that one of, I mean, I agree with what has been said, but it's, I guess it is related to the issue that I had raised earlier, that cyber underwriting is a relatively new area and a growing area, and I focused more on issues about underwriting standards, given the lack of data. But I think the gentleman's question is also about the lack of case law. So when you come to settle claims, is there, what is, I mean, even if the legal framework is in place, how exactly this legal framework is going to be implemented is not something that that we yet know. So once is we do need the legal framework, and that legal framework needs to be robust, and the support of the regulators. But the second thing is, it is a new area, and there are risks both to the clients, but also potentially to the insurers who are underwriting that business.
Okay. Yeah.
Peut-être, parce que il y a quelques minutes,
Now, a few minutes ago, we talked about the business model in the insurance sector, and we also talked about another issue. But in both cases, I'd like to insist on the following. In other words, we're probably going to be shifting from a curative to preventive model, and prevention is, in the insurance business, is going to become very, very instrumental, given the wealth of all the data that are going to be at hand. And we know that prevention can really strongly reduce claims and cost of social protection in both of the public and private sectors. I believe that this represents a genuine collective objective, with hopefully the support of the regulatory bodies.
That is another way of like new business model, which is insurance as a service versus risk prevention, and really to compare it to like white goods. You buy white goods and then you decide, oh, do I buy maintenance for 3 years or not, and or if it breaks, would I just go buy a new one? So I think that's exactly the risk prevention model becomes like what Aviva and RSA are doing with LickBots and through HomeServe. It will become a real thing, and that's another way of new business models again that insurance companies have to think about and have to price. So.
Okay. We have a similar question from the public, actually, regarding cyber insurance. Stakes are high. How to behave as an insurer to deal with this new risk? Is it co-insurance? Is it reinsurance? But also, as mentioned here, prevention will also be, and cybersecurity, putting the right measures together with your insurer on how to prevent cyber risk will be, of course, an important lever.
In cyber, we call it, you have to have the right hygiene.
Yes, which is a continuous process and continuous training. Yeah. Any other questions from the audience for the panel?
I'm working for Smithcastle Insurance. I got a question addressed to you, gentlemen, to you, sir. You were saying that tomorrow prevention might allow us to improve quite a number of things, but are we not heading towards a unique or single society in which insurers will actually dictate or impose the right behavior? In other words, don't smoke, jog 3 times a week, don't drink any alcohol, and so on and so forth. Do you not believe that our societal model is somewhat dangerous, in my opinion? Thank you for raising the issue. Indirectly, I had already anticipated this type of concern by reminding you that we are subject to general data protection rules. Now, in no way will insurers carry out actions that could be misinterpreted by their customers. So we are responsible for defining the right or drawing the right line here, but I'm not going to go as far as you did, but perhaps with a lot of rationale, we could provide a genuine service to our insurance holders. And to them, it's not going to be a problem from an individual standpoint, but this might actually generate lesser claims or a reduction in their claims and good protection on their side. And in that framework, this is a genuine objective which we can all actually cherish. Thank you.
Coming in, I think it's an important one. What role are large online platforms going to play in insurance? Perhaps, Homaira, if you can give me your view on that.
No, absolutely. I do think they're going to play an important role over time. I mean, I think they're just sensing it. So many of you might be aware that Amazon bought a company called Ring for $1 billion. And the reason they bought Ring is, get hold of that camera technology, but really, I think, to get into insurance business. So smart home, in many ways, so it's really about insurance, not security is prevention, risk prevention, and then insurance. So actually just a week ago, Travelers announced that they just introduced Quantum Home 2.0 insurance for home, and they actually open a storefront on Amazon, and when you click on that, you go and you see that they're selling Amazon's, the Ring's camera or smart home or an Alexa. And Comcast is doing the same thing now. They are working with the insurance company Hippo, and same. I mean, they also offer security services, home security services. And when you go there, they're also selling insurance. So one of the things about these big platforms, which are, threatening every sector, every industry, and frequently people think they are much more powerful than actually fintechs or insurtechs or other tech, industrial techs, is that they have zero cost of customer acquisition. Yeah. So it's crazy because the customer is there, trusts them, works with them. So just adding on this, they can have they can make a small margin, which is still big margin, because they have zero customer acquisition cost. So I do think one has to watch for them.
There also is the issue of trust. They are trusted by the customer because they have a lot of interaction with the customer.
Yes,
they know what the customer wants and can play in on that.
Exactly.
Écoutez, indépendamment du problème.
Independently of market players, which I'm going to talk about later on, anything that is online now is unavoidable because we need subscribers, subscriptions, just to explain, inform, and educate. This is absolutely instrumental, and this is a good way to have potential subscribers trust you. And online also enables you to really follow up on contracts and ease management in case claims occur. So no problem here. Now, in terms of subscription, either products are very simple, and it can be a good way of providing subscription to people. Now, if the mechanism is more complex, we're now getting into a hybrid type of model, because why would an insurance holder for a complex product, why would that person trust a broker, a banker, or a general insurer? Why would he actually shy away from this type of advice and really turn to a new intermediary? Now, unless the new intermediary might provide more advantageous products, but this is not a given. And so far as marketplaces are concerned, I believe that this again could be a good way for developing insurance products. Why? Because there might be an easy way of understanding and implementing things here. I'm talking about the proposed insurance policy. For example, guarantee, warranty extension. This could be easily provided. And for all of those products requiring further explanations, perhaps in that case, the insurance sector would have a hard time to develop further. Thank you, Pierre. Thank you very much. Thank you to all the panel members, and thank you for all of the very interesting remarks and for this very nice discussion. Thanks to the audience.